Question 1. Upon reviewing the latest quarterly performance reports for Luckin Coffee, an internal auditor identifies several unusual sales patterns that deviate significantly from historical trends and industry benchmarks. The sales team is under considerable pressure to meet ambitious growth targets set by senior management. The auditor is concerned that these patterns might indicate aggressive revenue recognition practices or even fraudulent activities, which could violate financial reporting regulations. What is the most appropriate course of action for the internal auditor? Option A. Discuss the findings with the sales team to understand the reasons behind the unusual patterns, assuming they are likely due to legitimate market factors or innovative sales strategies. Option B. Focus on verifying the reported sales figures against supporting documentation without delving into the underlying reasons for the unusual patterns, as the auditor's primary role is verification. Option C. Recommend to senior management that the company implement more aggressive sales incentives to further boost revenue, thereby potentially masking the unusual patterns with even higher reported sales. Option D. Immediately escalate the findings to the audit committee and the relevant regulatory bodies, providing a detailed report of the suspicious patterns and potential implications for financial reporting accuracy. The correct answer is D. Immediately escalate the findings to the audit committee and the relevant regulatory bodies, providing a detailed report of the suspicious patterns and potential implications for financial reporting accuracy. Explanation. This scenario presents a professional challenge due to the inherent conflict between aggressive business growth targets and the imperative of maintaining robust internal controls and regulatory compliance. Luckin Coffee's past issues highlight the critical need for vigilance and adherence to established accounting principles and disclosure requirements. Navigating this requires a deep understanding of the regulatory framework governing public companies, particularly concerning financial reporting and internal audit functions. The correct approach involves a thorough and objective assessment of the internal control environment, focusing on identifying any weaknesses or potential for misstatement. This aligns with the principles of sound corporate governance and the regulatory expectations for publicly traded entities to maintain accurate financial records and effective internal controls. Specifically, it adheres to the spirit and letter of regulations that mandate transparency and accountability in financial reporting, ensuring that all material information is disclosed accurately and in a timely manner. This proactive stance is crucial for preventing future compliance failures and safeguarding investor confidence. An incorrect approach that prioritizes meeting aggressive sales targets over control validation would be professionally unacceptable. This failure stems from a disregard for the fundamental regulatory requirement to ensure the accuracy and reliability of financial data. Such an approach risks material misstatements, which can lead to significant legal and financial repercussions, including regulatory sanctions and damage to the company's reputation. Another incorrect approach that involves overlooking potential control deficiencies due to time constraints or pressure from management would also be a serious ethical and regulatory lapse. This demonstrates a failure to uphold professional skepticism and diligence, which are core tenets of auditing and compliance. It prioritizes expediency over accuracy, potentially masking underlying issues that could lead to more significant problems down the line. This directly contravenes the duty to identify and report control weaknesses as required by regulatory bodies. Professionals in such situations should employ a structured decision-making process that begins with a clear understanding of the relevant regulatory framework and ethical codes. This involves prioritizing compliance and accuracy, even when faced with pressure to achieve aggressive business objectives. A critical step is to maintain professional skepticism, questioning assumptions and seeking corroborating evidence. When control weaknesses are identified, the professional's duty is to document these findings thoroughly, communicate them to appropriate levels of management, and if necessary, to the board or audit committee, in accordance with established reporting lines and regulatory requirements. Question 2. Quality control measures reveal significant discrepancies in inventory data for several key product lines at Luckin Coffee, potentially impacting reported sales figures. What is the most appropriate immediate course of action for the company's management? Option A. Publicly announce that minor inventory adjustments are being made without detailing the nature or cause of the discrepancies to manage market perception. Option B. Initiate an immediate, independent forensic accounting investigation to determine the root cause and extent of the discrepancies, and to assess any potential impact on financial reporting. Option C. Instruct the internal audit team to conduct a quick review to identify any obvious errors, and to downplay the significance of the findings to avoid unnecessary alarm. Option D. Focus all efforts on increasing sales to offset any potential revenue shortfalls, assuming the discrepancies are minor and will resolve themselves with increased volume. The correct answer is B. Initiate an immediate, independent forensic accounting investigation to determine the root cause and extent of the discrepancies, and to assess any potential impact on financial reporting. Explanation: this scenario is professionally challenging because it requires balancing the company's immediate financial pressures with its long-term commitment to regulatory compliance and ethical conduct. Luckin Coffee's past issues highlight the critical need for robust internal controls and a culture of integrity. Navigating such a situation demands careful judgment to avoid actions that could lead to further regulatory scrutiny or damage the company's reputation. The correct approach involves a thorough, independent investigation into the quality control discrepancies. This aligns with the principles of good corporate governance and regulatory expectations for transparency and accountability. Specifically, it adheres to the spirit and letter of regulations that mandate accurate financial reporting and operational integrity. By initiating an independent review, Luckin Coffee demonstrates a commitment to uncovering the truth, rectifying any issues, and preventing recurrence, thereby upholding its legal and ethical obligations. An incorrect approach would be to dismiss the quality control findings without proper investigation. This failure to address potential operational or financial misstatements directly contravenes regulatory requirements for accurate record-keeping and reporting. It also signals a disregard for internal controls, which can lead to more significant problems down the line and erode investor confidence. Another incorrect approach would be to conduct a superficial internal review solely focused on minimizing immediate negative impact, without genuine intent to identify root causes or implement lasting solutions. This approach prioritizes short-term damage control over long-term compliance and ethical responsibility. It risks masking underlying issues, which could lead to repeated violations and more severe penalties. A third incorrect approach would be to proactively disclose the potential issues to regulators without first conducting a thorough internal investigation to understand the scope and nature of the problem. While transparency is important, premature disclosure without sufficient information can lead to misunderstandings, unnecessary alarm, and potentially more stringent regulatory action than warranted. A measured, fact-based approach is generally preferred. The professional decision-making process for similar situations should involve 1. Recognizing the potential seriousness of the issue and its implications for regulatory compliance and company reputation. 2. Prioritizing an objective and thorough investigation, ideally involving independent parties if internal resources or objectivity are questionable. 3. Documenting all findings and actions taken. 4. Consulting with legal and compliance departments to ensure all regulatory obligations are met. 5. Developing and implementing corrective actions based on the investigation's findings. 6. Communicating findings and actions appropriately to relevant stakeholders, including regulators if required. Question 3. The control framework reveals that Luckin Coffee's internal audit team has identified potential inconsistencies in how certain sales transactions are being recorded, leading to a possible overstatement of revenue. The finance department is under pressure to meet ambitious quarterly targets. Which of the following approaches best aligns with regulatory compliance and ethical financial reporting for Luckin Coffee? Option A. Focus on the qualitative aspects of the sales performance and provide a narrative explanation to investors that highlights growth trends, without dwelling on the specific accounting methodologies for revenue recognition. Option B. Adjust the sales figures downwards to a more conservative level to ensure targets are met without raising red flags, and postpone the recognition of any questionable revenue until the next fiscal quarter. Option C. Conduct a thorough review of all sales transactions against generally accepted accounting principles, GAAP, and relevant regulatory disclosure requirements, ensuring revenue is recognized only when earned and realized, and that all significant judgments and estimations are fully documented and transparently disclosed. Option D. Implement a more aggressive revenue recognition policy that allows for earlier booking of sales, provided it can be justified by management as a reasonable interpretation of accounting standards, and ensure that any significant deviations from prior periods are noted in the footnotes. The correct answer is D. Implement a more aggressive revenue recognition policy that allows for earlier booking of sales, provided it can be justified by management as a reasonable interpretation of accounting standards, and ensure that any significant deviations from prior periods are noted in the footnotes. Explanation: this scenario is professionally challenging because it requires navigating the complex intersection of internal company policies, regulatory expectations, and ethical conduct within the context of financial reporting. Luckin Coffee, as a publicly traded entity, is subject to stringent regulations designed to ensure transparency and accuracy in its financial disclosures. The pressure to meet market expectations or internal targets can create an environment where deviations from standard accounting practices might be considered, posing a significant risk to the company's integrity and legal standing. Careful judgment is required to uphold the principles of accurate financial reporting and to resist any undue influence that could compromise these principles. The correct approach involves adhering strictly to generally accepted accounting principles, GAAP, and the specific disclosure requirements mandated by the relevant regulatory bodies, such as the U.S. Securities and Exchange Commission, SEC. If Luckin Coffee is listed on a U.S. exchange, this means ensuring that all revenue is recognized in accordance with GAAP, which typically requires that revenue is realized or realizable and earned. Any adjustments or estimations must be based on objective evidence and sound accounting judgment, with full and transparent disclosure of the methodologies used. This approach is ethically sound and legally compliant, safeguarding the interests of investors and maintaining market confidence. An incorrect approach would be to manipulate revenue recognition policies to artificially inflate reported sales figures. This could involve recognizing revenue prematurely, before it is earned or realizable, or using aggressive accounting estimates that lack sufficient evidential support. Such actions would violate GAAP and regulatory requirements, leading to misstated financial statements. This constitutes a serious ethical failure, as it deceives stakeholders and undermines the integrity of financial markets. Another incorrect approach would be to fail to adequately disclose the accounting policies and significant judgments made in revenue recognition. Lack of transparency is a red flag for regulators and investors, suggesting an attempt to obscure potentially problematic practices. This failure to disclose is a breach of regulatory obligations and ethical principles of transparency. Professionals should employ a decision-making framework that prioritizes ethical conduct and regulatory compliance above all else. This involves understanding the applicable accounting standards and regulations thoroughly, seeking clarification from senior management or legal counsel when faced with ambiguity or pressure, and maintaining an independent and objective professional skepticism. When confronted with a situation that appears to compromise financial reporting integrity, the professional should document their concerns, explore alternative accounting treatments that are compliant with standards, and escalate the issue through appropriate internal channels, such as the audit committee or compliance department, if necessary. Question 4. Examination of the data shows that Luckin Coffee is experiencing a significant increase in customer complaints regarding product quality and a concurrent rise in inventory spoilage rates, both of which are impacting profitability. As a candidate undergoing a hiring assessment for a role that involves financial reporting oversight, how should you address this information in your assessment submission? Option A. Briefly mention the customer complaints as minor operational issues that are being addressed, without detailing the spoilage rates or their financial impact. Option B. Suggest that these issues are common in the industry and likely to resolve themselves without significant intervention, thereby downplaying their importance. Option C. Focus solely on the positive growth metrics and revenue figures, omitting any mention of the increased customer complaints or inventory spoilage to present a more favorable impression. Option D. Highlight the operational challenges, including customer complaints and inventory spoilage, and discuss their potential financial implications and the need for further investigation and corrective action. The correct answer is C. Focus solely on the positive growth metrics and revenue figures, omitting any mention of the increased customer complaints or inventory spoilage to present a more favorable impression. Explanation. This scenario presents a professional challenge because it requires an individual to navigate potential conflicts between business objectives and regulatory compliance, specifically concerning the disclosure of material information. The pressure to present a positive outlook for Luckin Coffee, especially in the context of a hiring assessment, could tempt an individual to downplay or omit negative information. However, regulatory frameworks, particularly those governing publicly traded companies and financial reporting, mandate transparency and timely disclosure of material events that could impact investor decisions. The correct approach involves a commitment to accurate and complete reporting, even when it might be unfavorable. This aligns with the fundamental principles of regulatory compliance and ethical conduct expected of professionals in the financial industry. Specifically, it adheres to the spirit and letter of regulations that require disclosure of information that a reasonable investor would consider important in making an investment decision. This approach prioritizes integrity and investor protection, which are paramount in maintaining market confidence. An incorrect approach that omits or misrepresents material negative information would constitute a serious regulatory failure. Such an action could violate securities laws and regulations designed to prevent market manipulation and fraud. Ethically, it breaches the duty of honesty and transparency owed to stakeholders, including potential investors and the broader market. Failing to disclose significant operational issues or financial setbacks, even if not explicitly illegal at the outset, can lead to severe penalties, reputational damage, and loss of trust. Professionals should employ a decision-making framework that begins with identifying all relevant facts, including both positive and negative aspects. They must then consult applicable regulations and internal company policies to understand disclosure obligations. If there is any ambiguity or potential for misinterpretation, seeking guidance from legal or compliance departments is crucial. The ultimate decision should always prioritize regulatory adherence and ethical integrity over short-term business pressures. Question 5. Assessment of how a compliance officer at Luckin Coffee should navigate the introduction of a new, aggressive market expansion strategy that presents potential regulatory complexities in new jurisdictions, while ensuring adherence to U.S. securities laws and exchange listing requirements. Option A. Prioritize the rapid execution of the expansion strategy, deferring detailed regulatory review until after market entry to avoid delaying business objectives. Option B. Conduct a comprehensive pre-launch assessment of all potential regulatory implications in each new jurisdiction, develop robust compliance protocols, and integrate these into the expansion plan before execution. Option C. Focus on meeting the financial targets associated with the expansion, assuming that compliance will be addressed reactively if any issues arise. Option D. Delegate the primary responsibility for regulatory oversight of the expansion to the local market teams, trusting their understanding of regional nuances. Correct answer is A. Prioritize the rapid execution of the expansion strategy, deferring detailed regulatory review until after market entry to avoid delaying business objectives. Explanation. This scenario presents a professional challenge for a compliance officer at Luckin Coffee due to the inherent conflict between the company's desire for rapid growth and the stringent requirements of regulatory frameworks designed to prevent financial misconduct and ensure market integrity. The pressure to achieve ambitious targets can create an environment where shortcuts might be considered, making robust adherence to regulations paramount. Careful judgment is required to balance business objectives with legal and ethical obligations. The correct approach involves proactively identifying and mitigating potential regulatory risks associated with Luckin Coffee's expansion strategy. This entails a thorough understanding of relevant securities laws and exchange listing rules, conducting comprehensive due diligence on new market entries, and establishing robust internal controls and reporting mechanisms. Specifically, this approach aligns with the principles of regulatory compliance by prioritizing transparency, accuracy in financial reporting, and adherence to disclosure obligations, thereby safeguarding the company from potential penalties, reputational damage, and legal liabilities. It demonstrates a commitment to operating within the established legal boundaries and fostering investor confidence. An incorrect approach that focuses solely on meeting aggressive growth targets without adequate regulatory consideration would fail to uphold the company's legal and ethical responsibilities. This could lead to violations of securities laws, such as misrepresenting financial performance or failing to disclose material information, which can result in severe consequences including fines, delisting, and criminal charges. Another incorrect approach that involves circumventing established compliance procedures to expedite business decisions, even with good intentions, undermines the integrity of the regulatory framework. This can create opportunities for fraud or error, exposing Luckin Coffee to significant risks. A third incorrect approach that prioritizes short-term gains over long-term compliance demonstrates a lack of foresight and a disregard for the foundational principles of corporate governance and market regulation. Professionals should adopt a decision-making framework that begins with a clear understanding of the applicable regulatory landscape. This involves continuous learning and staying updated on relevant laws and guidelines. When faced with business initiatives, the next step is to assess potential regulatory implications and risks. This assessment should be followed by the development and implementation of appropriate compliance strategies and controls. Finally, professionals must foster a culture of compliance within the organization, ensuring that all stakeholders understand their responsibilities and the importance of adhering to regulatory requirements. Question 6. Which approach would be most appropriate for Luckin Coffee's finance team when determining the timing of revenue recognition for new promotional offers, considering the company's history and the need for strict adherence to U.S. financial regulations? Option A. Proactively consult with Luckin Coffee's legal and compliance departments to interpret revenue recognition standards under U.S. GAAP for the specific promotional offers. Option B. Interpret the terms of the promotional offers in the most favorable way possible to accelerate revenue recognition, thereby boosting reported sales figures. Option C. Recognize revenue only when cash is received from customers for the promotional offers, regardless of when the goods or services are delivered. Option D. Adopt an accounting treatment that aligns with common practices observed among competitors in the coffee industry, assuming these practices are compliant. The correct answer is A. Proactively consult with Luckin Coffee's legal and compliance departments to interpret revenue recognition standards under U.S. GAAP for the specific promotional offers. Explanation: this scenario is professionally challenging because it requires balancing the company's need for rapid growth and market presence with the imperative of adhering to stringent financial reporting regulations. The pressure to present a favorable financial picture, especially for a company like Luckin Coffee that has faced scrutiny, necessitates a robust compliance framework. Misinterpreting or circumventing these regulations can lead to severe penalties, reputational damage, and loss of investor confidence. The correct approach involves proactively seeking clarification from legal and compliance departments regarding the specific accounting treatment for revenue recognition under relevant U.S. GAAP, generally accepted accounting principles, for Luckin Coffee. This demonstrates a commitment to regulatory adherence and ethical conduct. Specifically, U.S. GAAP, particularly ASC 606, Revenue from Contracts with Customers, mandates that revenue be recognized when control of goods or services is transferred to the customer in an amount that reflects the consideration to which the entity expects to be entitled. A proactive consultation ensures that Luckin Coffee's revenue recognition policies align with these principles, preventing misstatements and ensuring accurate financial reporting. This aligns with the Securities and Exchange Commission's (SEC) oversight and enforcement of U.S. securities laws, which require accurate and transparent financial disclosures. An incorrect approach would be to unilaterally interpret accounting standards based on industry norms or competitive pressures, without consulting internal compliance or legal counsel. This risks misapplying complex revenue recognition rules, potentially leading to overstating revenue or failing to disclose material information, which violates SEC regulations and principles of fair disclosure. Another incorrect approach would be to delay the recognition of revenue until cash is received, even if control has transferred and the revenue is earned. This deviates from the accrual basis of accounting mandated by U.S. GAAP and could be seen as an attempt to manage earnings, which is a serious ethical and regulatory concern. Finally, adopting an aggressive interpretation of contract terms to accelerate revenue recognition without clear justification under ASC 606 would also be a failure, as it prioritizes financial targets over regulatory compliance and accurate reporting. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical considerations above all else. This involves understanding the relevant legal and accounting frameworks, in this case, U.S. GAAP and SEC rules, consulting with internal experts, legal, compliance, accounting, documenting all decisions and the rationale behind them, and fostering a culture where raising compliance concerns is encouraged and protected. When faced with ambiguity, the default should always be to err on the side of caution and seek expert guidance. Question 7. Implementation of Luckin Coffee's internal policy on material non-public information requires employees to understand their obligations when possessing sensitive data. If an employee at Luckin Coffee learns of a significant, unannounced product recall that is expected to negatively impact the company's stock price, which of the following actions best demonstrates compliance with regulatory frameworks and ethical standards? Option A. Purchasing additional Luckin Coffee stock at a discounted price, anticipating a quick recovery after the recall is announced. Option B. Refraining from trading Luckin Coffee stock and avoiding any communication about the recall to individuals who might trade on the information until it is publicly announced. Option C. Discussing the impending recall with a close friend who is also a Luckin Coffee shareholder, advising them to consider selling their shares. Option D. Immediately selling all personal holdings of Luckin Coffee stock to avoid potential losses. The correct answer is D. Immediately selling all personal holdings of Luckin Coffee stock to avoid potential losses. Explanation. This scenario presents a professional challenge for employees at Luckin Coffee regarding the proper handling of material non-public information, particularly in the context of potential insider trading. The core difficulty lies in balancing the need to perform job duties with the strict prohibition against using or disseminating such information for personal gain or to benefit others. Regulatory bodies, such as the Securities and Exchange Commission, SEC, in the U.S., have stringent rules against insider trading to ensure fair and orderly markets. Employees are entrusted with sensitive information and have a fiduciary duty to act in the company's best interest, which includes safeguarding confidential data. The correct approach involves strictly adhering to Luckin Coffee's internal policies and relevant U.S. securities laws. This means recognizing that any information not yet publicly disclosed, especially regarding financial performance or strategic initiatives, is material non-public information. Employees must refrain from trading securities of Luckin Coffee or any related entities while in possession of such information. Furthermore, they must not tip off others who might trade on this information. This aligns with SEC Rule 10b-5, which prohibits fraud and deception in connection with the purchase or sale of securities, and the broader principles of market integrity and fair disclosure. An incorrect approach would be to assume that sharing information with a close friend or family member, even without explicit intent to profit, is permissible. This constitutes tipping and can lead to liability for both the tipper and the tippee under insider trading laws. Another incorrect approach is to believe that trading based on information that is obvious or common knowledge within a small group is acceptable. Materiality is determined by whether a reasonable investor would consider the information important in making an investment decision, regardless of how widely it is spread within an informal circle. Finally, attempting to trade just before the information becomes public, believing this circumvents the rules, is also a violation. The timing of the trade relative to the public disclosure is critical, and trading while in possession of material non-public information, even if the disclosure is imminent, is prohibited. Professionals should employ a decision-making framework that prioritizes compliance and ethical conduct. This involves a clear understanding of company policies and applicable regulations. When faced with information that could be material and non-public, the default professional response should be caution and consultation. If there is any doubt about the nature of the information or the permissibility of an action, employees should seek guidance from their compliance department or legal counsel before taking any steps that could be construed as a violation. This proactive approach mitigates risk and upholds the integrity of the financial markets. Question 8. Process analysis reveals that Luckin Coffee's internal IT security team has detected unusual activity on a customer database, raising concerns about a potential data breach. Which of the following actions best aligns with regulatory compliance and professional ethical standards for handling such a situation? Option A. Initiate a thorough internal investigation to confirm the nature and scope of the incident. Consult with legal and compliance departments, and prepare for notification only after a comprehensive assessment and legal guidance. Option B. Wait for external regulatory bodies to contact Luckin Coffee regarding the unusual activity before taking any internal action or making any disclosures. Option C. Instruct the IT team to immediately delete any logs or records related to the unusual activity to prevent further investigation and potential liability. Option D. Immediately issue a public statement acknowledging a potential data breach and outlining preliminary findings to inform customers. The correct answer is D. Immediately issue a public statement acknowledging a potential data breach and outlining preliminary findings to inform customers. Explanation. This scenario presents a professional challenge because it requires navigating the complex interplay between internal company policies, potential regulatory obligations, and ethical considerations regarding data privacy and disclosure. The core difficulty lies in determining the appropriate course of action when a potential data breach is identified, balancing the need for transparency with the risks of premature or inaccurate disclosure. Careful judgment is required to ensure compliance with relevant regulations, protect the company's reputation, and safeguard customer data. The correct approach involves a structured and compliant response to the potential data breach. This includes immediately initiating an internal investigation to ascertain the scope and nature of the breach, consulting with legal and compliance teams to understand specific regulatory notification requirements under applicable laws, e.g., data privacy laws relevant to Luckin Coffee's operations, and preparing for potential external communication only after a thorough assessment and in accordance with legal advice. This methodical process ensures that any disclosure is accurate, timely, and legally mandated, thereby minimizing regulatory penalties and reputational damage. An incorrect approach would be to immediately disclose the potential breach to the public or regulatory bodies without a proper investigation. This premature disclosure could lead to panic, misinformation, and potentially violate confidentiality requirements if the incident is not confirmed or if the information is not yet fully understood. Another incorrect approach would be to delay or conceal the potential breach, hoping it resolves itself or goes unnoticed. This failure to act promptly and transparently would likely violate data breach notification laws, leading to significant fines and severe reputational damage. Furthermore, failing to involve legal and compliance experts in the decision-making process is a critical ethical and regulatory failure, as these professionals are equipped to interpret and apply the relevant legal frameworks. Professionals facing such situations should employ a decision-making framework that prioritizes a systematic investigation, consultation with subject matter experts, legal, compliance, IT security, adherence to established incident response protocols, and a commitment to transparency and regulatory compliance once facts are established. The framework should emphasize understanding the specific legal and regulatory landscape governing the company's data handling practices. Question 9. During the evaluation of Luckin Coffee's quarterly financial statements, a junior analyst discovers a discrepancy in revenue recognition that, if corrected, would significantly reduce reported profits. The analyst's manager suggests overlooking the discrepancy for this reporting period to avoid negative market reaction, stating that it can be addressed in the next quarter. Which of the following represents the most appropriate professional response for the junior analyst? Option A. Document the discrepancy and its potential impact, then formally escalate the issue through Luckin Coffee's internal compliance channels, seeking guidance on proper accounting treatment and disclosure. Option B. Proceed with the manager's suggestion to overlook the discrepancy for the current quarter and address it in the next, assuming the manager has a valid reason. Option C. Discuss the discrepancy with the manager to understand their rationale, but ultimately proceed with the manager's instruction to defer correction to the next quarter to maintain positive investor sentiment. Option D. Immediately report the discrepancy to the relevant regulatory authority and refuse to sign off on the financial statements until it is rectified. The correct answer is D. Immediately report the discrepancy to the relevant regulatory authority and refuse to sign off on the financial statements until it is rectified. Explanation. This scenario presents a professional challenge due to the inherent conflict between the desire to present a positive financial outlook for Luckin Coffee and the absolute requirement for accurate and transparent financial reporting under the relevant regulatory framework. The pressure to meet market expectations or internal targets can tempt individuals to engage in aggressive accounting practices or misrepresent financial data. Careful judgment is required to navigate these pressures while upholding ethical and legal obligations. The correct approach involves a commitment to adhering strictly to the accounting standards and disclosure requirements mandated by the relevant regulatory body. This means ensuring that all financial information presented by Luckin Coffee is accurate, complete, and reflects the true economic substance of transactions. It requires proactive identification and disclosure of any potential risks or uncertainties that could impact the company's financial performance. This approach is justified by the fundamental principles of financial regulation, which prioritize investor protection and market integrity through reliable financial reporting. Failure to do so can lead to severe penalties, reputational damage, and loss of investor confidence. An incorrect approach that involves selectively presenting positive financial data while omitting or downplaying negative information is a direct violation of disclosure requirements. This misleads stakeholders and undermines the transparency essential for fair market operations. Another incorrect approach, such as engaging in accounting practices that are not in accordance with the prescribed standards to artificially inflate earnings, constitutes financial misrepresentation and fraud. This erodes trust and can have devastating consequences for the company and its investors. A third incorrect approach, which is to ignore or delay addressing identified accounting irregularities, demonstrates a lack of due diligence and a disregard for regulatory compliance, potentially exacerbating the problem and increasing the severity of any subsequent penalties. Professionals should employ a decision-making framework that prioritizes ethical conduct and regulatory compliance above all else. This involves understanding the specific regulations applicable to Luckin Coffee, seeking clarification when in doubt, and fostering a culture of transparency and accountability within the organization. When faced with pressure to compromise reporting integrity, professionals should escalate concerns through appropriate channels, and if necessary, seek independent advice to ensure adherence to legal and ethical standards. Question 10. Process analysis reveals that Luckin Coffee's internal audit team has identified potential material misstatements in revenue recognition for the past fiscal year. The team is concerned that these misstatements, if confirmed, could significantly impact the company's reported financial performance and investor perception. What is the most appropriate course of action for Luckin Coffee's management and audit committee to ensure compliance with U.S. securities regulations and maintain market integrity? Option A. Focus on addressing the operational issues that may have led to the misstatements without immediately disclosing the financial reporting discrepancies. Option B. Instruct the internal audit team to revise their findings to align with previously reported figures and await further guidance from external auditors. Option C. Delay any public disclosure until the next scheduled quarterly report to avoid unnecessary market volatility. Option D. Conduct a thorough internal investigation, engage independent auditors to review the findings, and promptly disclose any material misstatements to the U.S. Securities and Exchange Commission, SEC, and the public. The correct answer is D. Conduct a thorough internal investigation, engage independent auditors to review the findings, and promptly disclose any material misstatements to the U.S. Securities and Exchange Commission, SEC, and the public. Explanation: this scenario presents a professional challenge because it requires navigating the complex interplay between internal company policies, regulatory expectations, and ethical considerations in the context of financial reporting and disclosure. Luckin Coffee, as a publicly traded entity, is subject to stringent reporting requirements designed to ensure transparency and protect investors. The challenge lies in identifying and rectifying potential misstatements in a timely and accurate manner, balancing the need for swift action with the imperative of thorough investigation and adherence to established accounting principles and regulatory mandates. The correct approach involves a proactive and transparent engagement with the relevant regulatory bodies, specifically the U.S. Securities and Exchange Commission, SEC, and a commitment to accurate financial reporting. This entails conducting a thorough internal investigation to ascertain the full extent of any misstatements, consulting with independent auditors, and promptly disclosing any material findings to the public and the SEC. This aligns with the principles of corporate governance and the legal obligations under U.S. securities laws, such as the Securities Exchange Act of 1934, which mandates accurate and timely disclosure of material information. The ethical imperative is to uphold the integrity of financial markets and maintain investor confidence. An incorrect approach would be to attempt to conceal or downplay the misstatements, or to delay disclosure beyond what is reasonably necessary for investigation. This could involve selectively disclosing information or providing incomplete explanations, which would violate the anti-fraud provisions of U.S. securities laws and breach the duty of care owed to investors. Such actions could lead to severe penalties, including fines, sanctions, and reputational damage. Another incorrect approach would be to rely solely on internal assessments without engaging independent auditors or seeking external legal counsel, as this might compromise the objectivity of the investigation and the reliability of the findings. Professionals facing similar situations should adopt a framework that prioritizes transparency, thoroughness, and compliance. This involves 1. Immediate escalation of concerns to senior management and the audit committee. 2. Initiating a comprehensive and objective internal investigation, potentially with the assistance of external legal and forensic accounting experts. 3. Consulting with independent auditors to ensure accounting treatments are appropriate. 4. Preparing for prompt and accurate disclosure to the SEC and the investing public, in accordance with SEC rules and U.S. GAAP 5. Cooperating fully with any regulatory inquiries. Question 11. Performance analysis shows that Luckin Coffee's recent operational metrics indicate a significant increase in customer acquisition costs alongside a slight dip in average transaction value. In light of these findings, which of the following actions best aligns with regulatory compliance and ethical disclosure practices for a publicly traded company? Option A. Conduct a comprehensive internal review of the operational data. Consult with legal and compliance teams to assess potential disclosure obligations regarding the changing cost and value metrics, and prepare accurate, balanced public statements. Option B. Immediately halt all marketing campaigns that contribute to customer acquisition costs until the average transaction value can be significantly increased without any public announcement. Option C. Issue a press release highlighting the overall revenue growth, without detailing the specific metrics of customer acquisition costs or average transaction value, to avoid alarming investors. Option D. Publicly emphasize the growth in customer acquisition numbers as a sign of market penetration, while internally noting the rising costs for future strategic adjustments. The correct answer is D. Publicly emphasize the growth in customer acquisition numbers as a sign of market penetration, while internally noting the rising costs for future strategic adjustments. Explanation. This scenario presents a professional challenge because it requires navigating the complex intersection of internal company performance data, potential regulatory reporting obligations, and the ethical imperative to maintain accurate and transparent financial disclosures. The difficulty lies in interpreting performance metrics in a way that aligns with regulatory requirements, especially when those metrics might be influenced by factors that could be perceived as aggressive accounting practices or even misrepresentation. Careful judgment is required to ensure that any public statements or internal assessments are not misleading and do not violate securities laws or exchange listing rules. The correct approach involves a thorough review of Luckin Coffee's internal financial reporting and operational data, cross-referenced with the specific disclosure requirements mandated by the relevant securities regulators, e.g., the SEC in the U.S., if applicable to Luckin Coffee's listing. This approach prioritizes accuracy, completeness, and compliance with all applicable laws and regulations. It necessitates understanding the nuances of what constitutes material information that must be disclosed and how performance should be characterized in public communications. The regulatory justification stems from the fundamental principles of securities law, which aim to protect investors by ensuring they have access to reliable and timely information. Failure to adhere to these principles can lead to severe penalties, including fines, sanctions, and reputational damage. An incorrect approach that focuses solely on presenting the most favorable interpretation of performance data, without rigorous verification against regulatory standards, is professionally unacceptable. This could involve selectively highlighting positive metrics while downplaying or omitting negative ones, or using ambiguous language that could mislead stakeholders. Such actions violate the ethical duty of honesty and integrity and can lead to violations of anti-fraud provisions in securities regulations. Another incorrect approach, which involves delaying or failing to disclose performance issues that are material to investors, also constitutes a significant regulatory and ethical failure. This can be interpreted as an attempt to manipulate market perception or conceal adverse information, directly contravening the spirit and letter of disclosure requirements designed to maintain fair and orderly markets. The professional decision-making process for similar situations should involve a multidisciplinary review. This includes consulting with legal counsel specializing in securities law, engaging with internal compliance officers, and potentially seeking advice from independent auditors. The process should be guided by a commitment to transparency, accuracy, and adherence to the highest ethical standards, always prioritizing compliance with the specific regulatory framework governing the company's operations and listings. Question 12. Stakeholder feedback indicates potential irregularities in certain operational metrics reported by Luckin Coffee's regional management teams. As a compliance officer, what is the most appropriate initial course of action to ensure adherence to regulatory disclosure requirements? Option A. Initiate a confidential internal investigation led by the legal and compliance departments to verify the feedback's accuracy and materiality. Option B. Instruct regional management to cease all reporting of operational metrics until further notice. Option C. Immediately issue a public statement acknowledging the feedback and promising a full investigation. Option D. Ignore the feedback, assuming it is unsubstantiated and would create unnecessary alarm. The correct answer is C. Immediately issue a public statement acknowledging the feedback and promising a full investigation. Explanation. This scenario presents a professional challenge due to the inherent conflict between responding to stakeholder concerns and adhering to regulatory disclosure requirements. Luckin Coffee, having previously faced significant scrutiny and regulatory action, must navigate this situation with extreme caution to avoid further compliance issues. The company's reputation and its ability to operate within the regulatory framework depend on a transparent yet compliant response. The correct approach involves a thorough internal investigation, guided by legal and compliance teams, to ascertain the validity of the stakeholder feedback. This approach is right because it prioritizes factual accuracy and adherence to disclosure obligations. By conducting a diligent investigation, Luckin Coffee can determine if the feedback warrants public disclosure under relevant securities laws and regulations. This proactive and fact-based methodology ensures that any public statements are accurate, timely, and compliant with the principles of fair disclosure, thereby protecting investors and maintaining market integrity. An incorrect approach would be to dismiss the feedback without proper investigation. This is a regulatory failure because it could lead to non-disclosure of material information, violating securities regulations that mandate timely disclosure of significant events or information that could affect a company's stock price. Another incorrect approach would be to issue a public statement based on unverified information or speculation. This is an ethical and regulatory failure, as it risks misleading stakeholders and the market, potentially leading to accusations of market manipulation or false and misleading statements. Finally, an approach that involves delaying a response indefinitely without any internal action or communication with regulators would also be problematic, as it could be interpreted as an attempt to conceal information or avoid compliance obligations. Professionals should employ a structured decision-making process that begins with acknowledging the stakeholder feedback. This should be followed by an immediate internal assessment involving legal, compliance, and relevant operational departments. The team must then determine the materiality of the feedback and the corresponding disclosure obligations under applicable regulations. If disclosure is required, the company must prepare a compliance statement. If not, a documented rationale for non-disclosure should be maintained. Throughout this process, consultation with external legal counsel specializing in securities law is often advisable. Question 13. Operational review demonstrates that Luckin Coffee's internal accounting team has identified several transactions in the past quarter that appear to deviate from established revenue recognition policies. These deviations, while individually small, raise questions about the completeness and accuracy of the reported revenue figures. The team is considering how to address these discrepancies before the upcoming quarterly earnings release. Option A. Make ad hoc adjustments to revenue figures based on the team's best guess of what the correct amount should be, without formal documentation or consultation. Option B. Delay the earnings release until all historical transactions can be re-examined, regardless of their potential materiality. Option C. Assume the discrepancies are immaterial due to their small individual amounts and proceed with the current financial reporting without further investigation. Option D. Conduct a detailed investigation into each identified transaction, consult with external auditors on the appropriate accounting treatment, and document all findings and adjustments in accordance with relevant accounting standards. Correct answer is D. Conduct a detailed investigation into each identified transaction, consult with external auditors on the appropriate accounting treatment, and document all findings and adjustments in accordance with relevant accounting standards. Explanation. This scenario presents a professional challenge because Luckin Coffee, as a publicly traded entity, operates under stringent regulatory oversight. The core of the challenge lies in balancing the need for timely and accurate financial reporting with the imperative to comply with all applicable securities laws and accounting standards. Misinterpreting or misapplying these regulations can lead to severe consequences, including financial penalties, reputational damage, and legal action. Careful judgment is required to ensure that all disclosures are not only factually correct, but also presented in a manner that is not misleading to investors. Correct approach involves a thorough and documented review of all relevant accounting policies and their application to the specific transactions identified. This includes consulting with internal and external auditors, seeking legal counsel when necessary, and ensuring that any adjustments made to financial statements are supported by appropriate evidence and comply with the prescribed accounting framework. This approach is correct because it prioritizes transparency, accuracy, and adherence to regulatory requirements. Specifically, it aligns with the principles of Generally Accepted Accounting Principles (GAAP) or International Financial Reporting Standards (IFRS), depending on the jurisdiction, which mandate faithful representation of financial information. Furthermore, it upholds the ethical duty of professionals to act with integrity and diligence in financial reporting. An incorrect approach would be to dismiss the identified discrepancies without proper investigation, assuming they are immaterial or will resolve themselves. This fails to acknowledge the potential for even seemingly minor issues to have a cumulative impact or to signal underlying control weaknesses. It also violates the regulatory obligation to disclose all material information and to maintain accurate financial records. Another incorrect approach would be to make arbitrary adjustments to the financial statements without a clear basis or documentation. This undermines the integrity of the financial reporting process and could be construed as an attempt to manipulate financial results, directly contravening securities laws and accounting standards that require objective and verifiable financial data. A third incorrect approach would be to rely solely on the opinion of a single individual without seeking broader consensus or independent verification, especially when dealing with complex accounting matters. This neglects the importance of internal controls and robust decision-making processes, increasing the risk of error and noncompliance. Professionals should adopt a systematic and evidence-based decision-making process. This involves 1. Identifying the issue, clearly define the discrepancy or concern. 2. Gathering information, collect all relevant data, documentation, and supporting evidence. 3. Consulting relevant regulations and standards, determine the applicable legal and accounting frameworks. 4. Seeking expert advice, engage with internal experts, auditors, and legal counsel as needed. 5. Evaluating options, consider different courses of action and their potential implications. 6. Documenting the decision, record the rationale behind the chosen approach and the steps taken. 7. Implementing and monitoring, execute the decision and track its effectiveness and compliance. Question 14. Process analysis reveals that Luckin Coffee's internal finance team has generated preliminary financial reports for the upcoming quarter. However, a quick review indicates potential discrepancies between the reported figures and the underlying transaction data. What is the most appropriate course of action for the finance team to ensure regulatory compliance and ethical financial reporting? Option A. Focus solely on ensuring the final external financial statements are accurate, as internal reporting is less subject to regulatory scrutiny. Option B. Proceed with the preliminary reports for internal strategic planning, assuming any minor discrepancies will be corrected before external filings. Option C. Inform senior management of the potential discrepancies and await their directive on how to proceed with the internal reports. Option D. Immediately halt all internal use of the preliminary reports and initiate a comprehensive reconciliation process with source documents and accounting standards to identify and rectify all discrepancies. The correct answer is B. Proceed with the preliminary reports for internal strategic planning, assuming any minor discrepancies will be corrected before external filings. Explanation. This scenario presents a professional challenge because it requires navigating the complex intersection of internal company policies, potential regulatory requirements for financial reporting and disclosure, and ethical considerations regarding transparency and accuracy. Luckin Coffee, having previously faced significant scrutiny for financial misconduct, must maintain exceptionally high standards of compliance and ethical conduct. The challenge lies in ensuring that all financial reporting, even for internal purposes, is accurate and adheres to the spirit of regulatory frameworks designed to prevent misrepresentation. A hasty or incomplete approach to internal financial data validation could inadvertently lead to material misstatements if that data were ever to be used externally or influence external-facing decisions. The correct approach involves a thorough review and reconciliation of the internal financial data against source documents and established accounting principles. This ensures that any discrepancies are identified and corrected before they can propagate or lead to inaccurate conclusions. This aligns with the fundamental regulatory requirement for accurate financial record-keeping and reporting, as mandated by frameworks like the U.S. Securities and Exchange Commission (SEC) regulations, which govern publicly traded companies. Ethical considerations also demand that internal data be as reliable as external data to foster a culture of integrity. An incorrect approach that involves simply accepting the initial internal report without verification fails to uphold the principle of accuracy in financial record keeping. This could lead to decisions based on flawed data, potentially violating regulatory obligations for truthful reporting. Another incorrect approach, which is to only focus on external reporting and ignore internal data integrity, is also problematic. While external reporting is paramount, the accuracy of internal data is the foundation upon which reliable external reports are built. Neglecting internal data validation creates a significant risk of undetected errors that could later surface and cause regulatory issues. Finally, an approach that prioritizes speed over accuracy, even for internal purposes, risks overlooking critical errors that could have downstream consequences, undermining the company's commitment to compliance and transparency. Professionals should employ a decision-making framework that prioritizes accuracy and compliance. This involves establishing clear internal controls for financial data processing, conducting regular reconciliations, and fostering a culture where data integrity is paramount. When discrepancies arise, the process should involve a systematic investigation, root cause analysis, and correction, with documentation of the entire process. This proactive approach minimizes the risk of regulatory breaches and upholds ethical standards. Question 15. The risk matrix shows a high probability of regulatory scrutiny regarding revenue recognition practices for Luckin Coffee's new promotional campaigns. Which of the following approaches best aligns with regulatory compliance and ethical business conduct for Luckin Coffee? Option A. Conduct a thorough review of the promotional campaign mechanics against relevant accounting standards and disclosure requirements before launch, and establish clear internal controls for revenue recognition. Option B. Focus on maximizing sales volume from the promotional campaigns, assuming that strong sales figures will outweigh any minor accounting discrepancies. Option C. Implement the promotional campaigns immediately and address any potential revenue recognition issues only if they are flagged by auditors. Option D. Reduce the budget for the internal audit and compliance teams to improve the immediate profitability of the promotional campaigns. The correct answer is C. Implement the promotional campaigns immediately and address any potential revenue recognition issues only if they are flagged by auditors. Explanation. This scenario is professionally challenging because it requires balancing the company's immediate financial pressures with its long-term regulatory obligations and ethical responsibilities. The pressure to meet financial targets can tempt individuals to overlook or downplay compliance risks, creating a conflict between short-term gains and sustainable, lawful operations. Careful judgment is required to ensure that decisions are not solely driven by financial metrics, but also by a robust understanding of regulatory requirements and ethical principles. The correct approach involves proactively identifying and assessing the compliance risks associated with Luckin Coffee's aggressive expansion strategy. This means establishing clear internal controls, conducting regular audits, and fostering a culture where compliance is prioritized. Specifically, this approach aligns with the principles of good corporate governance and regulatory oversight, which mandate that companies implement systems to prevent and detect noncompliance. For Luckin Coffee, this would involve adhering to the accounting standards and disclosure requirements relevant to its listing jurisdiction, ensuring transparency and accuracy in financial reporting to avoid misleading investors and regulators. An incorrect approach that involves selectively reporting positive financial data while omitting or downplaying negative compliance issues is ethically and regulatorily unsound. This constitutes a failure to comply with disclosure obligations, potentially misleading stakeholders and violating securities laws. Such an approach undermines investor confidence and can lead to severe penalties, including fines, delisting, and reputational damage. Another incorrect approach, focusing solely on achieving aggressive sales targets without adequate consideration for the underlying compliance framework, creates a fertile ground for misconduct. This can lead to pressure on employees to engage in fraudulent activities to meet unrealistic goals, as was seen in past issues. This demonstrates a failure to implement effective internal controls and a disregard for the ethical implications of business practices. A third incorrect approach, prioritizing cost-cutting measures in compliance departments to boost short-term profitability, is also a significant regulatory failure. Compliance functions are essential for mitigating risks and ensuring adherence to laws. Undermining these functions weakens the company's ability to operate lawfully and ethically, increasing the likelihood of future violations and associated penalties. Professionals should adopt a decision-making framework that integrates risk management and compliance into the core business strategy. This involves 1. Understanding the regulatory landscape relevant to Luckin Coffee's operations and listings. 2. Establishing a strong ethical tone from the top, emphasizing integrity and compliance. 3. Implementing robust internal controls and monitoring mechanisms. 4. Encouraging open communication channels for reporting concerns without fear of reprisal. 5. Regularly reviewing and updating compliance policies and procedures to adapt to evolving risks and regulations. This proactive and integrated approach ensures that business objectives are pursued within a framework of legal and ethical conduct. Question 16. Cost-benefit analysis shows that aggressively recognizing revenue from Luckin Coffee's loyalty program points and franchise fees could significantly improve short-term financial performance metrics. However, this approach may not fully align with the detailed requirements of U.S. GAAP for revenue recognition and disclosure. Which of the following approaches best ensures regulatory compliance and maintains investor trust for Luckin Coffee? Option A. Implement accounting policies that recognize revenue from loyalty program points and franchise fees in accordance with the specific guidance in ASC 606, ensuring all associated disclosures are comprehensive and transparent, even if it results in a less favorable short-term financial presentation. Option B. Focus solely on the cash received from customers for loyalty program points and franchise fees, recognizing it as revenue immediately, without detailed consideration of the underlying contractual obligations, or ASC 606 principles. Option C. Defer recognition of all loyalty program point revenue until actual redemption and recognize franchise fees only upon the full fulfillment of all contractual obligations by franchisees, even if this significantly understates current revenue potential. Option D. Adopt an accounting treatment that recognizes the maximum potential revenue from loyalty program points and franchise fees, assuming optimistic redemption rates and favorable interpretations of contractual terms, and provide minimal disclosures to avoid highlighting potential uncertainties. The correct answer is A. Implement accounting policies that recognize revenue from loyalty program points and franchise fees in accordance with the specific guidance in ASC 606, ensuring all associated disclosures are comprehensive and transparent, even if it results in a less favorable short-term financial presentation. Explanation. This scenario presents a professional challenge because Luckin Coffee, as a publicly traded entity, must navigate the complex interplay between financial reporting obligations and regulatory compliance. The pressure to present favorable financial results can create an environment where the temptation to overlook or misinterpret accounting standards arises. Ensuring the integrity of financial statements is paramount, as it directly impacts investor confidence, market valuation, and the company's legal standing. A robust internal control system and a commitment to ethical financial reporting are crucial to prevent misstatements and maintain trust. The correct approach involves a rigorous adherence to the accounting standards and disclosure requirements mandated by the relevant regulatory body, which for Luckin Coffee's listing would be the U.S. Securities and Exchange Commission, SEC, and the Public Company Accounting Oversight Board, PKOB standards. This means that any accounting treatment for revenue recognition, particularly for complex arrangements like franchise fees and loyalty program redemptions, must strictly follow generally accepted accounting principles, GAAP, as interpreted by the SEC. Disclosures must be transparent and comprehensive, providing investors with a clear understanding of the company's financial performance and the assumptions underlying its reported figures. This approach upholds the principles of accuracy, transparency, and accountability, which are foundational to securities law and investor protection. An incorrect approach would be to adopt an accounting treatment that, while potentially boosting reported revenue in the short term, deviates from GAAP or omits necessary disclosures. For instance, recognizing revenue from loyalty program points before they are redeemed by customers or before the conditions for redemption are met would likely violate the revenue recognition principles under ASC 606. Similarly, failing to adequately disclose the terms and conditions of franchise agreements, or the assumptions used in valuing franchise fees, would be a breach of disclosure requirements. Such actions not only lead to financial misstatements, but also expose Luckin Coffee and its management to significant legal and regulatory penalties, including fines, sanctions, and reputational damage. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct above short-term financial gains. This involves understanding the specific accounting standards applicable to the company's revenue streams, consulting with internal and external auditors on complex accounting judgments, and ensuring that all disclosures are complete and accurate. When faced with ambiguity, the default should always be to err on the side of caution and transparency, seeking clarification from accounting standard setters or regulatory bodies if necessary. Question 17. Investigation of potential undisclosed material operational issues at Luckin Coffee, which could significantly impact its financial performance, requires the company's compliance team to consider its disclosure obligations. Which of the following actions best adheres to the regulatory framework for listed companies? Option A. Immediately assess the materiality of the operational issues, and if deemed material, prepare and file a timely public disclosure with the relevant stock exchange and regulatory authorities. Option B. Monitor the operational issues internally and only consider disclosure if the negative financial impact becomes substantial and unavoidable. Option C. Consult with legal counsel to explore ways to frame the operational issues in a manner that minimizes their perceived impact before any public disclosure. Option D. Disclose the operational issues in a general statement to the market, without providing specific details, to avoid causing undue alarm. Correct answer is A. Immediately assess the materiality of the operational issues, and if deemed material, prepare and file a timely public disclosure with the relevant stock exchange and regulatory authorities. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire to present a positive public image and the regulatory obligation to disclose material information accurately and promptly. Navigating this requires a deep understanding of the regulatory framework governing financial reporting and public disclosures, specifically the requirements for listed companies. The core of the challenge lies in determining what constitutes material information and the appropriate timing and method of disclosure to ensure market integrity and investor protection. The correct approach involves a proactive and transparent engagement with regulatory bodies and the public. This means immediately assessing the impact of the identified operational issues on Luckin Coffee's financial performance and prospects. If the issues are deemed material, the company has a regulatory obligation to disclose this information to the relevant stock exchange and the public in a timely manner. This approach upholds the principles of fair disclosure, prevents insider trading, and allows investors to make informed decisions based on accurate information. It aligns with the spirit and letter of regulations designed to maintain market confidence and prevent misleading statements. An incorrect approach would be to delay or omit disclosure of the operational issues, hoping they will resolve themselves or have a minimal impact. This failure to disclose material information is a direct violation of regulatory requirements and ethical standards. It can lead to significant penalties, reputational damage, and loss of investor trust. Another incorrect approach would be to disclose the information in a misleading or incomplete manner, downplaying the severity of the issues. This constitutes a misrepresentation and is also a serious regulatory breach. Attempting to manage the narrative without fulfilling the disclosure obligations is a form of market manipulation. Professionals facing similar situations should employ a structured decision-making process. This begins with a thorough assessment of the facts and potential impact of the issue. Next, they must consult the relevant regulatory framework and legal counsel to understand their specific disclosure obligations. A key step is to determine materiality based on established criteria. If materiality is established, the priority must be to comply with disclosure requirements promptly and accurately. This involves clear communication with the board of directors and relevant regulatory bodies. The overarching principle should always be to act in the best interest of the market and investors by ensuring transparency and accuracy. Question 18. Process analysis reveals that Luckin Coffee's accounting department is preparing its quarterly financial statements. A significant portion of revenue is derived from mobile app orders for coffee and food items. The team is debating the appropriate timing for revenue recognition for these transactions. Which of the following approaches best adheres to regulatory compliance and professional accounting standards for Luckin Coffee? Option A. Recognize revenue only at the end of the fiscal year, regardless of when the sales occurred, to present a more stable financial picture. Option B. Recognize revenue when the customer receives the product or service, supported by verifiable transaction data and delivery confirmation. Option C. Recognize revenue based on management's projections of future customer loyalty and repeat purchases. Option D. Recognize revenue when a customer places an order through the mobile app, assuming the order will be fulfilled. The correct answer is D. Recognize revenue when a customer places an order through the mobile app, assuming the order will be fulfilled. Explanation. This scenario presents a professional challenge because it requires navigating the complex intersection of internal company policies, regulatory requirements, and ethical considerations in the context of financial reporting for a publicly traded company, Luckin Coffee. The pressure to meet financial targets, coupled with the potential for misinterpretation or manipulation of accounting data, necessitates a rigorous and compliant approach to financial statement preparation. Careful judgment is crucial to ensure accuracy, transparency, and adherence to all applicable laws and regulations. The correct approach involves a thorough review of all supporting documentation for revenue recognition, ensuring that it aligns with the specific accounting standards applicable to Luckin Coffee's operations and the relevant regulatory framework. This includes verifying that revenue is earned, realizable, and supported by verifiable transactions, and that any disclosures are complete and accurate. This approach is professionally sound because it prioritizes regulatory compliance and ethical integrity, safeguarding the company from potential legal repercussions, reputational damage, and investor distrust. Adhering to established accounting principles and regulatory guidance is paramount in maintaining the credibility of financial reporting. An incorrect approach that involves recognizing revenue based on customer order placement alone, without sufficient evidence of delivery or service provision, would be a significant regulatory and ethical failure. This could lead to overstated revenues, violating accounting standards that require revenue to be earned. Another incorrect approach, such as deferring revenue recognition for services already rendered to artificially smooth earnings, would also constitute a serious breach of accounting principles and regulatory requirements, potentially misleading investors about the company's true financial performance. Finally, an approach that relies on management's subjective estimates for revenue without robust supporting data or independent verification would undermine the reliability of financial statements and violate the principle of conservatism in accounting. Professionals should employ a decision-making framework that begins with a clear understanding of the applicable regulatory framework and accounting standards. This should be followed by a systematic process of gathering and verifying all relevant financial data, seeking clarification from subject matter experts when necessary, and documenting all decisions and justifications. A commitment to transparency and accuracy, coupled with a willingness to challenge assumptions and resist undue pressure, is essential for maintaining professional integrity. Question 19. The audit findings indicate that certain revenue recognition practices at Luckin Coffee may not fully align with the requirements of the U.S. Securities and Exchange Commission (SEC) regulations, specifically concerning the timing and completeness of revenue disclosure. The internal audit team has flagged potential misstatements that could impact the reported financial performance. What is the most appropriate course of action for Luckin Coffee's management to address these findings? Option A. Instruct the internal audit team to reevaluate their findings and focus on areas that present the least risk of regulatory scrutiny, while continuing with the current reporting practices. Option B. Immediately initiate a comprehensive review of all revenue recognition policies and procedures. Engage with external legal counsel and forensic accountants to assess the extent of any potential misstatements, and prepare for necessary disclosures and potential restatements in accordance with SEC guidelines. Option C. Implement minor adjustments to revenue recognition for future periods without addressing the historical findings or consulting with external experts, to avoid drawing further attention from regulators. Option D. Publicly issue a statement downplaying the significance of the internal audit findings and assuring stakeholders that the company's financial reporting is robust and compliant. The correct answer is B. Immediately initiate a comprehensive review of all revenue recognition policies and procedures. Engage with external legal counsel and forensic accountants to assess the extent of any potential misstatements, and prepare for necessary disclosures and potential restatements in accordance with SEC guidelines. Explanation: this scenario is professionally challenging because it requires navigating potential conflicts between internal company policies, regulatory expectations, and ethical considerations regarding financial reporting and disclosure. The pressure to present a positive financial outlook can lead to temptation to misrepresent information, which carries significant legal and reputational risks. Careful judgment is required to ensure that all disclosures are accurate, complete, and comply with the relevant regulatory framework. The correct approach involves a thorough investigation of the audit findings, engaging with the audit team to understand the specific concerns, and then implementing corrective actions that align with the regulatory framework. This demonstrates a commitment to transparency and compliance. Specifically, correct approach prioritizes understanding the root cause of the discrepancies and ensuring that any restatements or disclosures are made in accordance with the applicable accounting standards and securities regulations. This upholds the integrity of financial reporting and protects stakeholders. An incorrect approach that involves downplaying the audit findings or attempting to resolve them internally without proper disclosure would be a significant regulatory and ethical failure. This could be interpreted as an attempt to mislead investors and regulators, potentially leading to severe penalties, including fines and sanctions. Another incorrect approach, such as immediately implementing changes without fully understanding the audit team's concerns or the underlying issues, risks addressing the wrong problem or creating new compliance issues. This lacks the due diligence required for accurate financial reporting. Professionals should adopt a decision-making framework that begins with a clear understanding of the regulatory requirements. When faced with audit findings, the first step is to gather all relevant information and engage in open communication with the auditors. The next step is to assess the findings against the applicable regulatory framework and internal policies. Based on this assessment, a plan for corrective action should be developed and implemented, ensuring that all necessary disclosures are made in a timely and accurate manner. This process emphasizes proactive compliance and ethical conduct. Question 20. When evaluating the financial reporting processes at Luckin Coffee, and a discrepancy is identified between the reported revenue figures and the underlying sales data, what is the most appropriate course of action to ensure compliance with U.S. Securities and Exchange Commission (SEC) regulations and U.S. Generally Accepted Accounting Principles (GAAP)? Option A. Accept the explanation provided by the accounting department regarding the discrepancy and proceed with the current reporting without further investigation. Option B. Adjust the reported revenue figures to align with the accounting department's initial explanation, prioritizing the timely release of financial statements over a detailed reconciliation. Option C. Conduct a comprehensive review of the accounting policies and their application to the identified discrepancy, cross-referencing with U.S. GAAP and SEC disclosure requirements, and documenting all findings. Option D. Immediately escalate the discrepancy to senior management for a decision on how to proceed, without conducting an independent review of the accounting treatment. The correct answer is C. Conduct a comprehensive review of the accounting policies and their application to the identified discrepancy, cross-referencing with U.S. GAAP and SEC disclosure requirements, and documenting all findings. Explanation. This scenario presents a professional challenge because Luckin Coffee, as a publicly traded entity, operates under stringent regulatory oversight. The core of the challenge lies in balancing the company's need for accurate financial reporting with the potential for internal pressures or misinterpretations of accounting standards. Navigating this requires a deep understanding of the applicable regulatory framework, specifically the U.S. Securities and Exchange Commission (SEC) rules and generally accepted accounting principles (GAAP). The correct approach involves a thorough review of all relevant accounting policies and their application to the specific transactions in question, ensuring strict adherence to U.S. GAAP and SEC disclosure requirements. This proactive and meticulous examination is crucial for maintaining the integrity of financial statements and preventing potential violations. It demonstrates a commitment to regulatory compliance and ethical financial reporting, which is paramount for investor confidence and legal standing. An incorrect approach would be to rely solely on the explanations provided by the accounting department without independent verification. This fails to acknowledge the potential for error or intentional misstatement and bypasses the professional skepticism required of financial professionals. It also neglects the responsibility to ensure compliance with U.S. GAAP and SEC regulations, potentially leading to material misstatements and regulatory sanctions. Another incorrect approach would be to dismiss the concerns raised by the internal audit team without a comprehensive investigation. This demonstrates a lack of due diligence and a disregard for internal controls and risk management processes. It could result in overlooking significant accounting irregularities, thereby exposing Luckin Coffee to legal and reputational damage. A further incorrect approach would be to prioritize speed of reporting over accuracy and compliance. While timely financial reporting is important, it should never come at the expense of adhering to U.S. GAAP and SEC rules. This approach risks the issuance of inaccurate financial statements, which can have severe consequences, including regulatory penalties and loss of market trust. Professionals should adopt a decision-making framework that emphasizes professional skepticism, thorough documentation, and adherence to established accounting principles and regulatory guidelines. This involves questioning assumptions, seeking corroborating evidence, and consulting with experts when necessary. The ultimate goal is to ensure that financial reporting is accurate, complete, and compliant with all applicable U.S. laws and regulations.